Hey everyone, today I'm going to talk about Canada's two largest bank stocks, TD and RBC, and look at which one is the better buy right now. Both of these stocks pay high dividends and can be great options for TFSA investors. RBC's yield is 3.5%, while TD is up around 4.9%. But let's take a look at more than just their yields when making a decision. Over the past 5 years, RBC has been the far better stock to own, as its gains are up around 63%. TD, on the other hand, is up around just 25%. But one thing you'll notice from this chart is that they have actually gone typically in the same direction. They're generally highly correlated since they are the country's two largest banks, so they will perform similarly. There has been a big gap opening up in the past year when RBC stock has rallied while TD has struggled, and that's likely to do with the $3 billion money laundering charge TD was assessed in the US. That may have spooked some TD investors, leading to more money going into RBC, which may have been seen as the safer bank to buy. But it's important to remember that the past doesn't predict the future. While RBC has done better of late, that doesn't mean that pattern will continue. In fact, I wouldn't be surprised if this trend reverses as TD improves its policies related to money laundering and the bad news surrounding the business starts to fade. Plus, TD's lower valuation may entice investors to buy it. By looking at the respective price to earnings ratios, RBC does still look cheaper, trading at 13 times earnings, whereas TD is up over 18. But these are based on trailing earnings numbers. TD's been hit with those money laundering charges, which have hurt its bottom line. And as its earnings go down, the PE multiple rises, making it seem like a more expensive stock. This is where PE multiples can become a bit unreliable, as one bad quarter can have a big impact on the ratio. Assuming TD doesn't again fall into trouble with regulators, we would expect its earnings to rebound and for that multiple to come down. This is where the forward PE multiple comes into play, which is in the chart below. It's based not on trailing earnings, but the earnings that analysts expect from the business in the year ahead. I like the forward PE multiple because it effectively tells you what a company's earnings should be under a normal year, without any noise and unexpected one-time charges. And based on forward PE multiples, this is where TD starts to look like a cheaper stock to own. It's trading at a forward PE of just under 11, whereas RBC is at more than 12. It's not a huge difference, but it does paint a bit of a different picture here. One thing income investors may also want to focus on is dividend growth. Both of these stocks have raised their payouts for years, and over the past 10 years, TD has more than doubled its dividend payment. RBC has raised its dividend by more than 90%. Both are good dividend stocks, but TD has been a bit more generous with its rate hikes in the past, and its yield is already higher than RBC's today. Overall, the stock I'd go with today is TD. The market has been a bit bearish on it of late, but I think it'll bounce back. Buying it on bad news allows you to lock in a higher than normal yield for TD, and its cheaper price tag could result in bigger gains ahead. While RBC has done better of late, I wouldn't be surprised if TD becomes the better buy in the future. But overall, if you're investing for the long term, either one of these stocks can make for great investments to put in your tax-free savings account.